Thanks for clicking. The Bank of Canada will be cutting interest rates even before inflation is back to target. This according to a new report coming from TD Bank. The report argues that if the Bank of Canada leaves interest rates too high for too long, it risks sacrificing economic growth as it attempts to get inflation back down to target, meaning choosing a recession in favor of getting the CPI back down to 2%. Yet, says TD, this will be a difficult balancing act and a communication challenge, convincing Canadians that the bank isn't giving up on the inflation fight while lowering rates before it's won.
You are speaking to me.
Indeed, in this report from TD Bank comes amid new data from the United States coming out last week showing that it's not a straight shot back down to 2% inflation. So what I want to do today is go over the report from TD Bank, discuss some of the communication problems that the bank will have if it lowers rates before inflation is back to target, and then go over some of the glaring omissions contained in the TD report. We do have a big week this week with Canada's inflation data set to be released tomorrow, and I'm still working on getting some more information on the overnight repo operation that we discussed last week. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into TD's report. On to the report. As mentioned, TD Bank says that the central bank is expected to cut rates this spring, despite inflation running above target and shelter inflation still running hot. Were the Bank of Canada opt to not lower interest rates in the spring, it would risk running the economy aground.
We wouldn't want that to happen.
Indeed, even the report admits that shelter costs will have a significant impact on the CPI when rates are cut, and that even more upward pressure could be put on shelter costs as rate cuts put upward pressure on home prices.
You're getting one way or the other.
Yet, TD says that there are three main reasons why the Bank of Canada can still cut, regardless of what's going on with the inflation rate and regardless of what the impact will be on shelter prices, meaning home prices. First, TD says that the real policy rate is already in restrictive territory. And indeed that is the case, with a policy rate of 5% and an inflation rate of 3.1% and core inflation of 3.5%. The policy rate is in fact restrictive. Contrast that with December of 2021 when the inflation rate was running at 4.7% and the policy rate was 0.25%. The real interest rate was negative, meaning it made sense to borrow, as in real terms you were actually getting paid to borrow money.
It's a mystery to me. I could guess at the science.
Second, TD says that interest rate setting can contribute to financial risk, in much the same manner as the bank left interest rates too low for too long during the pandemic, which ultimately led to inflation. If the bank leaves interest rates too high for too long, says TD, that carries with it financial risks on the other side of the spectrum. And this also is indeed the case. Obviously, we're seeing the results of these higher for longer interest rates, with mortgage defaults on the upsurge, house prices decreasing, and the banks having to extend amortizations well over 30 years.
That's got nothing to do with this.
And finally, says TD Bank, although the Bank of Canada's preferred measures of inflation won't be at 2% when that first rate cut occurs, other measures of inflation are narrowing. So, says TD, even if inflation is running above target when that first rate cut occurs, the overall breadth of inflationary measures will be narrowing, meaning we see a lot of disinflation in the other measures in the CPI basket. So, according to TD, the Bank of Canada is well positioned to cut rates even with inflation above target, as rates are already in restrictive territory. Failure to do so could put Canada in a recession with the accompanying financial risk, and inflation is broadly coming down. Yet, says TD, even if the Bank of Canada were to cut rates, doing so while maintaining effective communication is going to be one of the toughest jobs in the financial industry this year. And the reason, of course, is inflation expectations. If the bank cuts rates when we're still above target and house prices take back off again, it's going to be difficult to convince Canadians that we're not going back to elevated inflation. TD references one study out of the United States, which found that for every 1% increases in house prices, households expect a 0.24% increase in the overall inflation rate. So, if Canadians see house prices go up by 10%, they're going to figure that inflation is going up by 2.4%. This despite all of the work that the bank has already done trying to lower expectations. And we've talked before at great length on this channel about how inflation expectations can be a self-reinforcing loop. People expect inflation to be high, so they spend now, putting upward pressure on prices, and then inflation goes up. As such, TD says that the bank is going to have the difficult job of explaining to Canadians that even if they cut rates and shelter prices go up, that inflation is not going to reignite. So, in summary, TD says that if the Bank of Canada wants to avoid a recession, they're going to have to cut rates, and the bank is going to be tasked with the difficult job of convincing Canadians that these rate cuts, even with the accompanying shelter price increases, that doesn't mean that all other prices are going to go up as well.
I call bullshit.
Yet, looking at this report, TD missed a big step in between lowering rates and convincing Canadians that those lower rates won't lead to higher inflation. Mainly, will higher shelter costs lead to higher inflation? You can't just skip over the validity of the premise and go straight to the convincing the population part.
Sure you can.
It's not just a matter of inflation expectations, which can and will put upward pressure on the inflation rate. If rent prices, which went up dramatically during the pandemic, go up as a result of rate cuts, then aren't people going to demand higher wages? Demand higher wages when wage demands are already accelerating at an annual rate of 5.7%, the highest since January of 2021. And isn't that especially the case if we don't get the recession that TD says the Bank of Canada is going to avoid by lowering rates? Further, as has been well documented by the Bank of Canada, if house prices go back up, then aren't people going to spend more vis-a-vis the wealth effect? The argument, documented by the bank, says that when house prices go up, people feel wealthier, and hence they spend more. They spend more into an economy that is just recovering from 8% inflation. If TD wants more information on this wealth effect, they can consult a report from TD, which found that for every dollar that a house prices increase, consumption gets lifted by 5%. Further, if shelter costs go up, if house prices increase, homeowners will have access to more credit, vis-a-vis the collateral effect. When Canada's average house price hit $816,000 in February of 2022, homeowners could access up to 80% of that home's value, or $653,000. Fast forward 2 years and that average house price is now sitting at $646,000, of which homeowners can access 80%, or $517,000, about $130,000 less in borrowing power than we had 2 years ago. So, if the Bank of Canada cuts rates in the spring and house prices shoot back up, which even TD says that they could, wage demands, the wealth effect, and the collateral effect could very well put more upward pressure on the inflation rate, an inflation rate which TD even admits won't even be at target. So, when TD makes the argument that the Bank of Canada's toughest task is going to be convincing the population that it can lower interest rates and omit shelter costs when considering inflation, it's missing a big step. Will there actually be inflation?
I wouldn't worry about it.
And make no mistake, the Bank of Canada knows this. It's well aware of what's going to happen to the real estate market if it cuts rates prematurely. The bank has noted the potential increase to house prices and resulting inflation in previous press conferences, and has also been adamant that the bank did in fact learn its lessons from the 1970s, that if it cuts rates too soon, inflation will reignite in short order. With that said, we will have a much better idea of where Canada's inflation data stands going into the spring market when it's released tomorrow from Stats Canada, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.